Welcome to Investing During Retirement. Frank Armstrong is the CEO and founder of Investor Solutions. He's a CFP and an AIFA. He's a NAPFA registered fee-only advisor. He serves as an expert witness in security arbitrations, mediation, and litigation with over 35 years of experience in the financial service industry and a bachelor's degree in economics from the University of Virginia. Frank Armstrong is also the author of Investment Strategies for the 21st Century, The Informed Investor, a hype-free guide to constructing a sound financial portfolio, The Retirement Challenge, Will You Sink or Swim, and Rescuing Your Retirement. Investor Solutions is an independent fee-only compensation financial advisory firm. We are registered as a large SEC investment advisor with over $350 million under management. The firm serves high net worth individuals, foundations and endowments, pension plans, and one foreign government. The firm competencies are objective investment advice, fiduciary managers and consultants, application of modern financial theory, global diversification, passive strategies, risk and cost control.
During the accumulation phase, the emphasis is on maximizing returns. You need to build up a nest egg required to support your family for 30 plus years. The objective is to replace your human capital, that is, your ability to go to work and earn income, with investment capital. More risk is acceptable for higher returns, and time is definitely on your side. Investing during retirement is entirely different. The emphasis shifts to lifetime income generation. You can't run out of money. You want to conserve your estate, and time has definitely become your enemy now. Retirees are all asking themselves the same basic questions. How much can I safely withdraw without running out of money? Can I hedge the portfolio against inflation? How can I make my nest egg last forever? And how can I get the most money to my heirs? The problem is much more complicated than during the accumulation phase. Withdrawals increase the risk of portfolio failure. If you think about it, while you're adding money to the portfolio each year, a little bit of fluctuation isn't going to cause the account to zero out. We have a long-term time horizon. We always have to plan for at least 30 years. Meanwhile, inflation's eaten away at your portfolio if you don't do anything about that. Taxes and expenses are always a concern, and then when you turn age 70 and a half, you're going to have to deal with the minimum requirements for withdrawals that the IRS lays down. Meanwhile, during this entire period, you're going to want to be doing your estate planning to maximize the amount of value that you can pass on to future generations. Traditional retirement planning assumptions are not much help at all because they're based on straight line returns year after year. Unfortunately, market returns are variable. The traditional assumptions went something like this. We're going to earn on average 10%, we'll withdraw 6%. That means the account's going to increase each year by 4%. We're going to die rich and the children are going to receive a windfall. Unfortunately, it just doesn't work like that. The fatal flaw in this logic is that market returns are irregular, and an extended down market will consume your capital. Return distributions are badly skewed, which means that many more bad things and many more good things will happen than in a straight line assumption. So many investors would have gone broke before their life expectancy had they planned on the old traditional assumptions. Modern retirement planning takes into account that returns are variable and builds a strategy that considers that. First thing we have to ask ourselves is, what are sustainable withdrawal rates? This is a pioneering study by Professors Cooley, Hubbard, and Waltz of Trinity College down in Texas. They did a historical backtesting from 1926 to the present day. They looked at 5 portfolios from 100% stocks to 100% bonds. And then they tested withdrawal rates from 3 to 12% over time frames of 15 to 30 years. Looking just at the 30-year time horizon, at 3% withdrawal rates, it didn't matter what your asset allocation was, 100% of the portfolios survived for at least 30 years. At a 4 to 5% withdrawal rate, we begin to see that asset allocation affects the results. Mixed portfolios did better than either 100% equities or 100% bonds. But it's important to understand that at a 5% withdrawal rate, almost half the portfolios, or 49%, failed before 30 years if they were invested entirely in bonds. At a 6% withdrawal rate, we begin to see substantial number of failures in the portfolios. 10% of the portfolios failed if they were invested in all stocks, while 73% failed if they were invested all in bonds. Only one portfolio had a 100% success rate, and that was 25% stocks, 75% bonds, but you couldn't have known the appropriate asset allocation in advance. At a 7% withdrawal rate, even the optimum asset allocation, which was 50% stocks and 50% bonds, produced a 10% failure rate. And of course, you couldn't have known that optimum asset allocation in advance either. At an 8% withdrawal rate, every single asset allocation plan produced unacceptable failure rates at any withdrawals above 7%. As you might suspect, failures were concentrated in the Depression and in the 60s and 73 to 74 periods. It's impossible to know when these are going to repeat, but across the board, failures are directly related to time and withdrawal rates. The longer the time and the higher the withdrawal rates, the more likely it is that the portfolio will fail. So the study clearly demonstrates the impact of withdrawal rates, time horizon, and asset allocation, but they weren't able to pin down exactly what asset allocation contributed to the mix. You'll notice here that at any rates above 7%, even with the optimum asset allocation, we have unacceptable failure rates. Historical back testing is useful, but it has some severe limitations. For instance, if you just took the sequence of years and returns and ran them backwards, you get entirely different results. Monte Carlo simulations can provide us with much more robust modeling. It's a statistical mathematical modeling used using random numbers with defined characteristics and multiple trials. It was developed originally in the Manhattan Project because no one knew where neutrons were, but we knew where they were probably. And so they were able to build atomic weapons using this kind of sampling technique. Anyway, it allows for multiple portfolio designs and an infinite number of cash flow variations, and if we want to, we can even simulate mortality in the problem. Models like this are extremely useful. They're an aid to decision making in an atmosphere of uncertainty. They can simplify complex processes, give us some valuable insights, and quantify likely outcomes. But remember, models are not reality. I mean, after all, they're just models. And models sometimes oversimplify, or the inputs could be wrong. We assume random distributions, serial correlation, and time frame selection all could be wrong for our model. And again, the future may not look entirely like the past. So it gives us valuable insight, but it's not a guarantee of future results. Monte Carlo simulators use a random number generation to simulate a possible future investment return. Each simulation is an equally likely outcome. Investors starting at the same time should all expect to get the same results. And then they do the process about 10,000 times, and then they examine the distribution of possible outcomes. When we look at the distribution of possible returns, as you'd expect, the failures are most likely to occur to investors that start a program at the beginning of a down market. The model assumes a constant withdrawal rate regardless of the investment outcomes. In other words, there's no mid-course correction possible in the model. Of course, in real life, you can always have a mid-course correction by reducing your retirement income if you need to. So for this discussion, we're going to assume that all the investment models have an assumed rate of return of about 10%. However, we're going to vary the risk or the standard deviation of the portfolios, and we're going to show you 10, 15, and 20% standard deviations on the portfolios. All of these assume a 6% withdrawal rate and a 30 years time horizon.